Hello and welcome to Franchise X Scale Your Future, brought to you by Livemint in association with 100x Growth Partners by Expertrons. In our last episode, we decoded what makes a business franchise ready. Today, we're going to go one step deeper into a founder's dilemma: which franchise model is right for me? India today has over 4,600 active franchisors and more than 2 lakh franchise outlets, making it the second largest franchise market in the world after the US. The industry itself is growing at 30 to 35% CAGR, projected to cross 150 billion by 2027. Yet many founders struggle to decide between company owned, company operated, or franchise owned, franchise operated models, or even the hybrid approaches. Each model comes with trade offs around control, investment, and scalability. To help us unpack this, I am joined by two powerhouses of franchising today: Vijay Kapoor, founder of Derby Responsible Menswear, which scaled to 95% franchise stores across India and created over 1,000 first generation entrepreneurs. He brings hard won lessons on overcoming failures, training franchises, and building an ethical, sustainable model. We also have Jatin Solanki, co-founder of Expertrons and 100x Growth Partners, the world's first growth accelerator for offline expansion of brands, founded by IIT Bombay alumni who have built and exited ventures to public listed entities. Before we dive into this interesting conversation, a quick reminder: if you are a founder doing over 5 Cr ARR and serious about scaling 100x, raising growth capital, and preparing for a strategic exit, 100x Growth Partner is offering a free accelerator consultation with Jatin and his co-founder Vivek. Together, they've built 300 plus franchise networks and exited ventures to listed entities. So they are perfect for helping you grow with 100x. Okay, so my first question would be to Mr. Vijay Kapoor. Derby has gone almost entirely franchise first. For someone new, how do you define the difference between the company owned model and the franchise owned model? And why did Derby choose the franchise owned, franchise operated model as the dominant model?
Yeah. I love you guys. Very happy to be here. Often in the industry terms, we call it as FOFO and COCO, franchisee owned and franchisee operated, and company owned and company operated. Initially, what happens whenever an entrepreneur starts a business, he starts it with a one store module or one business model, wherein he's trying to learn how to get his business model ready, how does he get his cash flow ready, how does he get his inventory, his product ready. But once he crosses the bridge, which takes probably a year or two, once he crosses the bridge and he has a stable business that is already performing, that has good, performance, it's doing profitable, he wants to scale the business. That's when this whole thing comes up: whether should I do a company-owned, company operated, or franchise-owned, franchise operated. In a company-owned, company operated, it is very investment heavy, wherein the company itself operates, or in our case, like Derby is a men's fashion wear brand, we have to in three investment that goes into it. One will be a rental investment because you're looking at a location, a physical store, wherein you have to pay a rental deposit for it. Second, it's not enough you have to get a store, but you also need to do the interiors that goes with your style, your brand identity. So how are you going to do the entire interiors to give a stable and a customer experience for the store? And the third investment goes into stocks. Now, all these are very capital intensive, and that's when the company initially, it's always better for the company to go in for a company owned, company operated. For us to understand, are we successful only in one single location? Or will we also be successful when we open up in multiple locations? Because when you're operating in one location, you have certain challenges. But when you're expanding and opening in multiple locations, your challenges completely change. How is your team going to be? How is your culture that you're going to be? What is going to be the customer experience you want to go? The product consistency. How are you going to retail the products? A lot of things have to be taken. So initial years are very important to stabilize the entire business model. It's better that you go for company-owned, company operated models for the second and third outlets, so that you have multiple case scenario where you're able to fine tune an entire business model, you're fine tune your teams, you're fine tuning your entire standard operating procedure so that there is seamless flow across. But once you cross this hurdle, you always have a choice of pivoting the business and getting it to franchise owned, franchise operated. Now, what do I mean by franchise owned, franchise operated? It's a very beautiful way of scaling up because beyond a certain part of time, you have only limited capital with you. But you're able to get another business partner into it. When I say partner, it's like a franchise partner who's willing to do the investment that's required. For example, he's willing to invest into the rental deposits, he's willing to invest into the interiors, he's willing to invest into the stocks. And in return, the company, the brand is willing to give all the support that's necessary for scaling up. For example, you have so many other things that you need to have your proper products in place. You need to have a marketing support. You need to have standard operating support. Everything is provided to the company, and that's when a franchise owned, franchise operated comes into being. But that is only possible when you already have a stable business model, you're already profitable, you have systems in place, and you have a team in place that understands how to franchise. Because what is very, very important, it's easy to get franchise partners. But what is very important is sustainable growth. You need to sustain your growth over a period of time. So that's where the franchise owned, franchise operated comes. Over a period of time, we realized initial years where we also used to do completely company owned, company operated stores across South. Then we decided we'll go for franchise owned, franchise operated, and we perfected the model. We understood from initial mistakes where were the shortfalls, and then we perfected the model to scale up.
Right. Thank you for
So,
that. Those insights. Yeah, Jatin. Yeah.
yeah, I mean, thanks for this, Vijay. I think amazingly put, and thanks, Mint, for this opportunity. I think you can, I mean, you can clearly see how it comes from an entrepreneur who has kind of did it himself and kind of faced it right from the beginning to where it has evolved to. Really good to see how the model evolved for Derby, of course. And of course, Paulomi, this part is very important, like how to choose between these different models. And most of the entrepreneurs, when you begin with, you have to kind of have that clarity on whether it makes
Right.
sense to kind of which kind of model to go ahead with. But like prior to
Yeah.
that, first figure out the product market fit, and once they have the product market fit and know that, hey, what kind of thing is replicable, what kind of thing is scalable, and based on that, kind of choose between what kind of models to go ahead with. But yeah, of course, initially, as Vijay rightly said, like founder has to kind of establish their single establishment, know that what is working, what is not working, what they want to control, what they want to give up control on, what things would be better to kind of hand it over to a partner, and based on that, kind of decide which kind of models to kind of go ahead with. But yeah, nicely put, Vijay. Yeah.
Thank you.
So that brings me to my next question to you, Jatin. So many founders feel safer with control, but they crave speed. So, what is this balancing act? Can you throw some light on that?
Yeah. So I think, as Vijay was saying, for Dirty specifically, and like of course for most of the companies, when you begin and when you do things, you realize that there are certain things as you expand or as you move to a different city, you would want help on, and which are kind of replicable, and where you and mainly, I think, of course, capital becomes one of the decision making factor. The new geography becomes one of the decision making factor, like when of course, when we started doing partner model for our own brands prior to this, we realized that as we were expanding, we of course, moving to a different geography, we would need certain help in those geography because we did not have the right connects to schools in those particular
Right,
geography.
right,
And for anyone expanding to a different city would kind of need that kind of support from a partner. And that's where we of course, and of course, it is also capital dependent, as Vijay mentioned. Like for his entity, of course, as they were expanding, they knew that there is a certain capital which would go in the deposits, in the
correct,
interiors, in the
correct,
inventory, a lot of those things. So as you're
right,
expanding, if as a founder, I have done say 5 stores in Mumbai, and as I'm expanding to different parts, I know that every expansion would take up or block this amount of capital of mine. And say if I have to invest 50 lakh in a store, and if I have to expand to say 10 different places, or even 100 different places. So that's like a 5 crore to a 50 crore of capital which is blocked. And if I have the funds, then of course the decision becomes kind of easier, but again riskier, because I take all the risk. And if I don't have the fund, then of course, then you have to kind of think on that. How will you expand? So those are the kind of questions usually the founders who are expanding kind of struggle with. Also, entering a new geography, it's always good to kind of have a partner in those geography, because you don't understand other geographies so well. So how an audience would respond, what kind of locations are the best in Kolkata versus a Chennai versus a Mumbai versus a Pune, or even a tier 2, tier 3 city. It would completely depend and would be more familiar to a partner in those geographies. So questions like those kind of becomes very important while you're expanding. And hence, like, as you said, like, it's easier to kind of make a decision when of course you have a capital, and then you need to think on that, how you're going to take your next steps. But when you don't have a capital, you're essentially looking for micro entrepreneurs. Like when we were expanding, we were looking for that, can I find micro entrepreneurs or mini Jatins across different places, who would basically in the morning wake up and think that how do I increase revenue of this company. And that's
Yeah.
kind of the most essential part. If someone is investing their time, investing their money on, of course, your business,
Mm.
every morning someone in Jaipur wakes up and thinks that how can I increase the revenue of this particular venture. And
Right.
that's something you want to do across Jaipur, Patna, Coimbatore, Kochi, all these different places. And of
Right.
course, and to the nuances of it, uh, does, like, what kind of model kind of becomes better? Do you kind of give out control and let the franchise own it and franchise operate it, which means that they have all the, like, they are kind of investing in it and they are also running the operations? Or do you want that, do you essentially are looking for capital from them and some kind of help, but you want to operate, or you want to own some part of the control of it? So that would essentially mean that franchise would invest, franchise would own it, but then company would want to operate it. That I want to keep the control of, say, teaching in those particular places. Say I'm a coaching institute and I'm kind of expanding pan India, and I want to keep the control of running the centers. I want to, say, run an NIIT center, or a JEE NEET coaching center in different cities. But I want to run it, but I want an investor in Jaipur, Patna, Coimbatore, Kochi, all these places. So it will depend on uh, the vision, the mission of the company as well. What kind of controls you want to keep with yourself, and do you want to kind of go ahead with a model which is franchise owned, franchise operated, or franchise owned but company operated? And again, these are just terminologies, frankly. It's mainly about what roles are being offered to the partner. The more roles and responsibilities taken by the partner, so say
Hmm.
they are playing a role of investor, they are actually playing the role of operations. The more role they take up, the more revenue share is what they are going to get, the more ROI is what they are going to get. So that's the bottom line of it. And that's also important, not only from the company side but also from the partner side. Like the partner needs to think that, what are they open for? What kind of responsibilities are they open for? Are they looking to invest and the companies to operate, or are they looking to invest and they are looking at themselves as an active partner? Because that's a very critical thing to know about the partner, because it's not only about onboarding a partner, but about creating a sustainable revenue, about creating a successful partner, about creating a successful model for the brand as well. And yeah, and hence, of course, a hybrid kind of model has been kind of picking up. Like if you see world's largest, like, a franchise network, 7-Eleven, they have like 85,000 franchise networks. And for them, they take the lease, or they own the land, and then they, of course, they take care of the cost of the daily operations. And of course the partner then runs the store, and then there is a revenue share, all of that happening. So it's not entirely fofo, it's not entirely foco, but they've created some, like, something in between which works for them. So yeah, I mean, it's essentially based on the mission vision of the company, and
Yeah.
we want to expand.
So just to add to, so as someone who's new to this, I have a quick question.
Sure.
Doesn't it depend? This is an entirely customized, solution, right? I mean, the risks that we speak of, or between a coco and a fofo,
Right.
will would it not depend so much on the nature of the business, or
It
is
well,
solely dependent on if the person has capital and
hundred
what
percent,
level of risks are involved. I
hundred
mean, it's for
percent right.
both of you, the question.
Yeah,
Okay.
yeah. So
No.
yeah, Vijay.
Just adding to what Jatin was saying, most founders have this fear of losing control when they franchise. But
Yeah,
one thing I always believe is you can be better than 100 people, but you cannot do 100 people's work. If Vijay wants to be in 100 stores, physically it's not possible for me to be there. So one way to get into a franchise, or the way to look at it, how do you prepare your mind, is saying that I'm looking at, like what he said, miniature Jatins. I'm looking at Vijay's who can represent me in different locations. But
right,
when you're doing that, you don't expect them to be 100% like you. Even if they are 70% efficient as you are, is good enough. First. Second is that we need to understand any business comes with a risk, including a franchise business. If you just Google and see, you will see that 80% of businesses that open up in India shut within the first 5 years. 80% failure rate. But franchise model just turns it other way around, wherein 80% success rate, 20% failure rate. It's like the responsible gardener who knows when he's planting the plants, only about 8 out of 10 will catch root. The balance two, he will have a responsibility of weeding them out. So there's always a risk involved with franchising. There's always a risk that the franchisee takes when he opens a business. And the reason, in spite of all the vetting that we do in terms of location vetting, in terms of franchise vetting, in terms of
right,
understanding the cultural fit, in terms of understanding the mindset, in spite of training, there's always a 20% failure chances that happens. And the failure chances are basically because of various factors, including locations or basically the franchise attitude towards business that shifts over a period of time. So we need to be
right,
very, very careful on this. Secondly, speaking about this business models, I only spoke about FOFO and franchise owned, franchise operated, and company owned, company operated. There
right,
are two more models which are actually emerging right now. That is company owned, franchise operated, something like what he spoke about 7-Eleven.
hybrid,
Company owned property and franchising operated, wherein the company is also investing on the property and the franchisee is probably taking care of the daily operational expenses and all that, and he's also getting a revenue share on it or is getting a royalty. He's paying a royalty fee to the franchisor. The
right,
other part is franchise owned, company operated. That means the entire investment is coming from the franchisee. In our case, for example, clothing store, the investment in terms of your rental deposits, investment in terms of store interiors, investment in terms of stocks is coming from the franchise partner. But the franchise partner is very clear, I'm here to invest, but don't ask me to operate. I'm not very good operating the store. Can the company operate it for me? So that's in that places we get company, we put in the company complete team from the company, right from the manager to all the team, put the SOP in place, train them up, and ensure we operate it to safeguard the franchise interest and the profitability. So yeah, Jatin, you can go ahead.
So I
Jatin,
think
would you
nicely
like
put.
to add?
Nicely put, Vijay. Actually, and I mean, of course, it actually is. I mean, of course, these are terminologies, but it completely depends. As I said, it depends on the mission, vision of the company, what they want to kind of give control on, and of course, on the partners, like what they are looking to get into. Like, are they actually looking to operate? Because it's very essential for them to know that yes, I'm looking to not only invest, but I'm actually looking to operate, because then it kind of makes sense to kind of get into an association like that. And as Paul, me, you said that there's also company owned, company operated. Of course, like and that's what Vijay was saying, talking about that. Many founders, they fear that I want to keep the entire control. I want to own the outlet and I want to run the outlet, and that's essentially company owned, company operated. Basically, when they have the funds, the means to do it, and second, they believe that they could run it the best. But then, of course, there the restriction is how much can you scale. You may
Yeah.
have some capital, but you may not have unlimited capital. So you may have, say, you may have raised a series A or series B, or like may have 50 crore or 100 crore or even a private equity capital, but then still you're limited with the capital you have, because each of these expansion is capital intensive, and it requires not only capital, time, energy, and specifically, which Vijay was mentioning, founder is only one person. So of course they may have all the ESOP, and they'll have all the good team and everything in place. But as you expand, you need more responsible people in each of these geographies. An employee can only play a certain level of role while they are expanding. Not every outlet you put an employee and they'll look at these outlets as their own. So that's also very essential, and that's why, like, one of these largest success stories you see across US and even in China, you have seen franchising kind of go really crazy. In the US, of course, we are aware of all these brands like McDonald's or Starbucks or Subway, all of them. But like China recently, with Luckin's Coffee being at 23,000 outlet, and this year an IPO which went out, which is Mixu, they have 46,000 outlet. After 2019, they added like 23 stores
Wow.
every day. And there, of course, the kind of growth they've seen, they are essentially like a factory, and they supply
Yeah.
their cups and straws and bubble tea and coffee and like everything to ice creams to these outlets. So they don't look at franchising as a tool. They only look at it like a distribution, and they've made the kind of investment, the kind of everything so easy, so effortless for the partner. And of course, they've got the product market fit right, they've got the pricing market fit right. Not to kind of underestimate any of that, you of course have to get like all of these things right before kind of you're on an expansion spree, because it's not only about expanding but about creating a sustainable revenue. Like if you are able to do it in your 5 outlets, in your 10 outlets, and you know that we can kind of make it into a scalable model, the partners will be successful, then of course this kind of expansion makes sense. And there again, as I said, like all these outlets, of course, they are looking for partners, and basically franchising gives you the means to kind of give ownership to someone else, as Vijay and I were discussing, like having mini Jatins or mini Vijays around all your stores. So now Vijay is very comfortable ki his one store outside of Chennai, there they have like a mini Vijay sitting there and concerned about ki, is the store profitable, is the team performing. They are looking at the accounts, they are looking at the books, they are making sure. They may be visiting daily, or some of them may be visiting once a week or something, but like still there's a leadership, or there's a founder level responsibility in those respective outlets. Vijay doesn't have to kind of walk into each of his outlets. So that's the kind of comfort he has with, of course, having so many partners. And hence, like, kind of franchising helps with those things. Models may differ, as we were mentioning. There is, of course, FOFO, FOCO, COCO, and the company owned and franchise operated, where you need the franchise to run the operations, but maybe company would want to invest in the outlet. So models may vary, and the models may vary only as per the responsibility which is being shared by the partners. And absolutely, Paulomi, you also mentioned one point. It is also dependent on which kind of
Which
business
line of business? Yeah.
we are into. So it's highly dependent on that. Like in teaching example, I just mentioned that in teaching you want to be careful that the partner doesn't, like, faculty is something, like say in JE NEET coaching classes, you want to control the faculty, you want to control the teaching. That is the entire experience. and uh,
Correct.
and hence you would want to kind of maybe operate some of these places. So I mean, it of course depends on which domain or sector you're into. And I mean, it is essential to kind of only give responsibilities of things you know that the partner will be able to handle, or will be able to kind of scale faster. And that kind of is the key to success, to kind of creating. I mean, it is not only about creating 10 or 100 outlets. If you're on an expansion spree, as I said, in China they did 46,000 outlets. So retail is yet to kind of have that kind of explosion in India. I know of a brand based out of Navsari in Gujarat, and they are already in 200 places just in Gujarat. They are yet to expand pan India. I know of a brand again in southern part of India, like a salon brand, like 800 plus outlets already, and they are yet to expand in the northern part. So the retail expansion is yet to happen in India, and it would for sure happen. Like and that's where it is important that you have a model which is more scalable, helpful for the partners, helpful for the founders, aligns with the vision, and giving the right support to the partners. Yeah.
Sure.
Just adding to what Jatin is saying, I have one philosophy that I've always believed in. Where your time goes, there your future comes. So whenever the energy of the businessman or the entrepreneur goes into the business flourishes. So when you have a partner, the reason I'm trying to explain this and remove the mind block some of the people have, some of the entrepreneurs have for franchising is that will I lose the brand identity? Will I lose my customer experience? Will I get a bad reputation? But just by having a company-owned, operated outlet, and you're having a store manager who's probably paid 30 or 40,000 rupees,
Yeah.
he may not perform. He may not have the type of intensity in making the business succeed. But if you're vetting your franchise partners, you know exactly what you're looking at the franchise partner. You're getting the stick marks. So there's a high probability because he's already invested about 50 lakhs to a crore rupees into the business. He's going to put in his energy into it. He's going to ensure his team is accountable to performance. Whenever you hold people accountable to performance, and whenever you're willing to actually take charge, the business turns around. Secondly, whenever it is a franchise-owned, franchise operated, he's also bringing in a lot of nuances which a company-owned outlets cannot do. For example, you will find far more efficiency out there in terms of turnaround times, in terms of cost efficiency. A lot of things that happens because of your owner is sitting out there to drive the business. But he has to at the same time work within the standard operating procedure that you have set, SOPs that have been set to operate that store. So when you do that, there's a perfect balance between an entrepreneurial spirit as well as the company's whole experience that you want to provide. And it's easy for you to
Right.
scale.
Right. So, Vijay, that brings me to the next question. I think you've partly answered it. Um, you know, Derby moved very decisively towards a franchise-owned, franchise-operated model. How did you balance, the risks? They may have lacked systems. You might have had some wins and losses. We want to know, how did you go about building this into a more secure space for the business?
Initially, we were very early. We started the business in 1994. By 2000, we were already expanding and opening stores. And initially,
Right.
we were only looking at that time, franchising was not a very big thing. So we were only opening company-owned, company-operated stores, operating them and doing exceptionally well. And that's when we decided that we want to franchise when the opportunities came. Because when you're expanding, there's always inquiry that comes in. And that point of time, we had only one mindset of company-owned, company-operated. There are two separate mindsets I want to again remind. Just because you're operating in probably 10, 15 locations, you have your own store, you think you can franchise one or two locations and you can go in. It just doesn't happen. You need to have the mindset of a franchisor. You need to ensure you're able to put in team that is going to handle this. Because the issues that you face when you run your own outlets, the issues that you face when you're running a franchise outlets are completely different, are totally different.
True.
We need to understand that this mindset has to be developed, systems and processes need to be developed. And initially, Darby was also a victim to this. We thought just because we're operating so many stores, we are very successful in the stores, highly profitable. Someone asking a franchise, just give it to him. We never realized that just opening another store is not enough, but we need to have system and processes to ensure that we're ensuring the SOP is maintained out there.
The
That
standardization, very
standard, yeah.
essential.
Education is
Standardization.
there, and the franchise partner is involved in the business. The franchise training is good enough. The locations, we do not let any of us franchise partners select the location because in retail, from 1 to 5, we look at the priority list. It's all location, 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 location. Unless until you don't have a good location which has natural footfalls, it's very difficult for you to sustain the business. So when you let a franchise partner select the location, sometimes the location is not the best. He'll always want to get a location because he already has a location. He wants to take a franchise, or if feels the other location is much better, it may be just a few blocks away, but that's cheaper in rent by probably about 20-30%. But I want to take that because it's cheaper in rent. And you do all these compromises when you're opening it, or he already has another brand and he wants to convert into your store, and he wants to compromise on the interior, saying that I already have the floor out here, I have the ceiling and light. Let's not spend too much of money. Let's retain it, and So when you start compromising in your entire business model, and it is not going to have the whole experience, anything that miss, we think the customers don't notice it. Customers have something called a subconscious understanding. When they go from one store to another store, they want a consistency in the same experience what they experienced every store. If you go to one Starbucks, whether it's in New York or whether it's in India, whether it's in
Yeah,
China, you need to have a similar experience across, right? From
exactly.
the
Yeah,
bartending, everything has to be have a similar experience. And customers
correct.
don't. They can even find the difference in taste, the flavor, whether the barista has enough experience in doing his job or not. Everything matters. So when we start compromising on this, not realizing the importance of, so when we paid the price for initial days, wherein we had compromised on the nature of the franchise, just because he had the money, we also franchised some of it. So we paid the price. We had to shut quite a bit of our franchise stores. We need to understand that the mindset that you need for a franchise business, the type of outlook that you need, the type of teams that you need to build, the type of systems you need to build are very different from operating your own store. They're two different mindsets. And you can have both a mindset, but you need to have two different teams to operate it. So we went through our own learning curve. So went through the challenges, understood our thing. We had to shut quite a bit of franchise stores, bear the losses, come out of it, and then again restart the entire thing by taking it back to the drawing board and understanding where our mistakes were. How do we fix this problem? How do we not compromise? How do we standardize things? How do we put a checklist for each and every item? You want a location? What is the geography out there? What is the type of purchasing power out there? Which are the other brands out there? I'm just going to minuter details. In every aspect, there are checklists that need to be there. Will this brand work out there? Will this franchise partner has a mindset that will go with the culture of the company? Will he be able to serve the customer with the customer first attitude? Does he have, is he self-motivated or is someone that needs constant motivation? Because if he's not self-motivated, it's not going to work. You can motivate him once, twice. He needs to be motivated because he's invested money into it. He needs to have a sense of responsibility towards it. So all these finer attributes that go, which are visible, not visible, everything is scanned, and multiple times it is through three different channels. It is three different teams with them before we finally take a call. Yes, are we going to go ahead with the franchise partner now? So it's been a complete learning curve, understanding what not to do, having done the mistakes, and now what we need to do. And how do we set two separate teams for both the separate operations? Don't intermingle them. At the end of the day, we need to understand. I mean, we are always speaking from the franchisor perspective, wherein we want to scale up, we want to do 500 crore, 1,000 crore. We're only speaking about us, but these are all people who are putting their life saving into business. A 50 lakh, 1 crore may not sound much to us, but someone's life saving. It's someone that they've saved, or probably they borrowed from friends and family. In some cases, also borrowed from outside. Initially, whenever we franchise, we say it has to be your own saving. We don't let people to borrow money and put it in because that adds a lot of stress to the entire business model. But someone's life. So we have a responsibility towards that. The word responsibility itself means responding with ability. What ability do we have to ensure we respond to the situation wherein we're safeguarding the franchise interest? We're ensuring that we're very, very, think that we need to ensure he's able to earn his money, he's able to make profit. And in case they're not able to make profit, not everything, like I said, 2 out of 10 don't work. So how do we ensure we're able to support them in those cases? How do we support them for them to grow? How do we, bring back the thing? Probably we give them some support in terms of rental support till they're able to come out of the, red into the green, or we give them team support, or we understand where the problem is, whether it's a franchise attitude that is there or the store location. So we go through, or sometimes we need to relocate the store into some other location. So how do we support the franchise partner during that? So all these go into it. And today, since we are a franchise first, understanding what we've been through, understanding that we have a responsibility. Today, we are proud that we have 95% of our stores are franchise, and it's ongoing.
Coming to apologies, there's something in my eye.
No, I think Vijay, I think you put it in a very beautiful way, and that just shows how 25 year of experience into this kind of looks like. So very beautifully put, and of course, like this is a journey which an entrepreneur needs to kind of go through and understand. 100% these both, like kind of running your own store versus actually managing these partners are completely two different businesses, two different things, and you of course need to have the vision to do that, vision to support these partners and everything. So that's something which is very essential part of the founder's journey. So really good to know how the Dervies have kind of went ahead with kind of providing that kind of support. We also have an example, like in our case, we were actually working with, of course, like other than of course having our own partners and providing them support and everything, we were actually working with one of these salon brands where we helped them expand to 18 locations, pan Mumbai, pan Maharashtra in the first quarter. And very interestingly, like the success of these salons are dependent on the number of appointments they get, the partners get. So within the ROI table, we had incorporated certain budget for marketing, And what we suggested to the company is that let's move the marketing to a central team, and we started supporting them on the marketing part, where we started actually, like, we put in a really good marketing leader, like a senior marketing leader. In otherwise, no one, like, individual stores, if they have to do their own marketing, they would have not been able to do that. But like when you're kind of putting 10 of these stores together, and you're assigning a senior leader, you're able to do that, because then you're able to afford the salary of that person, and you're able to run campaigns. But very interestingly, what happened is the appointments started getting to get booked, and each of these centers started to do well in terms of, I mean, their appointments were full, so they were doing well, they were breaking even faster. So if the break even period was, say, 10 months, it started happening earlier, it started happening in 8 months, it started happening in 7th month. One of these locations in Lokhandwala, the partner kind of came back and said that, hey, I want more outlets now. I'll Please book Chembur, please book Bandra for me. Kind of, it's also essential, as you rightly said, Vijay, that it is important to study that what are the gaps which a store is facing. How will we be able to support them through this journey of being red, and kind of turning into, say, yellow and then to green, because one is a break-even stage and then actually becoming profitable, and that's the journey. If someone can kind of goes through that journey and is able to kind of come in the green, then of course it's always a enlightening experience, and of course the partner is then very happy about it, that hey, they got to kind of wait through that period. And of course, location being one of the factors, maybe marketing, maybe the attitude of the partner, maybe like all these. And it's very important to kind of do those right checks and balances in places, and kind of provide that kind of support to these founders is very essential. One other case where we worked with founders, and these were two founders who actually had formed Being Human with Salman Khan previously, and now their new brand, they were only doing online. They were only working online, and of course the last year's revenue was also not that large, because they were only doing online. They wanted to, of course, do offline retail and everything, but then capital became one of the challenges. And like between us, when we discussed, we decided that initial few stores let the franchise invest, but then company will be operating. And within the first month, we were able to get them 5 partners without even a flagship store of their own, which was very interesting, because for them to kind of get into retail and get that support was essential. Also, these 5 stores now will be live before Diwali, so that's a very big win for them, because they were doing online. Now they have offline stores. They have that experience, and with that experience, of course, they plan to kind of in the next 5 years move towards 1,000 stores, move towards like a lot of these this thing in the journey. So yeah, I mean, examples like these kind of I mean, it as I said, it again depends on the mission, vision of the company, which direction they want to take. Uh, have the right support system in place to kind of support these partners. And you very rightly said, these are real people investing their own money, getting into entrepreneurship, tier 2, tier 3 city. They don't have an opportunity to, say, earn over 50,000 when they have to kind of go for a job or anything. But then that business is the only way to do that. And that's where they are looking for good founders to get associated with. They are looking for good business model to get associated with, good brands to get associated with, someone like your brand to kind of give them the right support and kind of like walk them through that journey. So that's like a very essential key to how a partner would look at it and how the brand should look at it, and there needs to be a balance in the both of it. Yeah.
Just to
So
add to one small hack that actually works for people who want to get into franchising,
Yeah.
who are confused between I want to do a Coco or a franchise-owned franchise operator. Generally, when you want to open a Coco store, it's always better you open it as a flagship store in a metro city or a larger city, wherein that actually gives you the entire brand image, the brand experience, and you're able to build and showcase what your brand stands for.
True.
So probably it's in a high footfall mall where you're actually able to build it and show it. So once you have this, you'll automatically be able to showcase this to the potential franchisees who could probably open it in Tier 2 and Tier 3 cities. So they have a business model, they're able to look at it, they're able to see how the whole operation goes, what the brand experience is, what the brand stands for.
True.
So that's a very beautiful way for potential, business owners to start off.
True. True. No, very very nicely put. Yeah, follow me, I think.
yeah. A question to the both of you. Let's just make this more practical for our audience. Beyond capital, what are the other factors that should influence a founder's decision to choose the right model beyond capital?
Uh, we find a lot of inquiries coming naturally into our site saying that I want a franchise, and a lot of people come in with the capital. A lot of times we have to reject it saying that no, we will not be able to give it because there's no cultural fit. See, when you're selling a fashion brand, I want the
Right.
person to understand the language of fashion. I want them to understand how a business needs to be run. Will they be able to follow a system? Will they be able to follow a process? Are they willing to get trained into it? Are they willing to put a team, or is it me, me, me? I will not put a team. I want to sit there. I will do everything. Are they willing to put in a team? Are they willing to look at the P&L on a monthly basis? Because end of the day, it's very easy to say the franchise is losing money. When the franchise is losing money, that means your brand is getting affected because you've blocked an entire area wherein you're not able to sell in that particular area because you're locked in a franchise partner and you know the potential of the area. That's why you're given a franchise here there. So it's not about one person losing money, it's even the brand loses money. Secondly, we are also ensuring that whatever money we put in, it also is going into marketing, is going to all the other support system. That means the brand loses much more when a franchise doesn't succeed. So it's very important. One, gratitude, the attitude of the franchise partner. Will he fit in? Will he fit into the entire franchise thing? Is he willing to follow the process systems? Is he willing to get trained and willing to follow the system? Now, a lot of people say that I don't like the franchise because it's like it's like a train going on a rail. That's what it is. The train cannot decide to go up. But the freedom of the train to go at any speed it wants to is only because of the rail. Remove the rail, it becomes chaos. It's an accident. So we need to understand when a franchise partner, when he comes to us itself, we ask him, are you willing to scale up? Are you only looking at one franchise? Initially, we only give one franchise outlet, but is he willing to grow out of it, save the money, and invest into multiple franchises? The idea is also how do we expand with a person? So we look at all these aspects: his attitude, his cultural fit, whether they're willing to follow systems, processes. Is he a team leader? Will he be able to scale up? If all these things are okay, and then we get into location. It's very, very important to get the right location, and then we follow through.
And Jatin, would you like to add to that? Any
Yeah,
thoughts on?
yeah, of course. So, of course, capital is one of the things which you rightly said is a factor on which kind of model you would want to expand into. But then, other than capital, of course, is uh, is fundraising a goal? Do you have the team in place to support these partners? So there are factors like these which are very important. So, example, if I am a QSR chain and I want to expand pan India, do I have the supply chain in place when I'm wanting to expand pan India, and when I'm kind of doing a 4-4 model? Do I have the right support system or right senior leaders in place to kind of help these partners and provide them the right support which is required? So questions like these would kind of matter to answer whether you could actually even do 4-4. For you to do 4-4, if I am a QSR brand and I want kind of senior leader in operations who is able to manage, say, 200 stores across Maharashtra, or maybe 400 stores across Maharashtra, Karnataka, and Gujarat, I may want a senior leader before even I plan that expansion. And to do that, maybe I would look at some of these good brands and I would look at that, can I kind of get these leaders to my brand? And for a brand who is much smaller than, say, a Rebel Foods or a Wow Momos, and I want the leaders from there to kind of come and join me, I would of course need to maybe have a private limited in place. I would want to have an ESOP pool in place. I would want to offer them certain equity to join me as an entity, and then say that, hey, you have a really big upside because there you are an employee, here you have equity, you have all of that. And now when we are in our journey from 100 store to 400 stores across 3 states or 2 states, or even pan India for that matter, uh, the growth will automatically give these employees or these senior leaders a growth. So questions like these are also very critical to answer. Even in terms of the fundraise, if you're kind of becoming a factory and you're kind of providing supplies to each of your outlets, and in those cases, a VC funding or a private equity funding would maybe prefer a model which is, say, an asset light model where you have royalty coming in and you have, say, 100 stores already with royalty coming in, and you have shown that this is a proven replicable model and you can kind of expand from 100 to 500 to 1000 stores. So it also depends on your fundraising goal. Is it a VC, PE, IPO goal which you have in mind? Also depends on whether you have been able to give control outside of your own circle of influence, or own family. Like many of these businesses are also family run, that it's only a husband, wife, brother running it. And as you want to expand, are you able to kind of give that control outside of your own circle of influence, and are you able to kind of bring in really good talented set of people and bring them in a partner, kind of like give out your equity to kind of bring them in. If you're able to kind of have that mindset and able to do things like those, then of course the which kind of model you get into kind of differs based on these decisions as well. So of course capital was the first thing. If you have capital and you're preferring coco, you can still do coco. If you don't have capital, then you will only have to do a franchise owned, and then maybe company operated, or franchise owned and franchise operated. But outside of that, of course, do you have the expertise, or do you have the right team in place to do it? And what are your fundraising goals? These are some of the other factors which would kind of help you with your decision on which kind of model do you want to expand with.
Great. And Vijay, I believe Derby's structured program turned 1,000 plus Indians into entrepreneurs. This whole approach that you must be partner first and not power first. I mean, can you elaborate on that a little bit?
We've learned it the hard way. Initially, like a typical entrepreneur, you're all the time worried about how do I expand, how do I, scale up, what do I need to do. It's all about
Mhm.
me. There comes a point where you understand that the only way you can win is by making others win. So that's where
Right.
the franchisee model or franchisee operated comes in, wherein you understand unless until you don't make your franchise partners profitable, unless until you're not franchise first, unless until you're not people first, customer first,
Right.
you do not
Right.
win. So that is a learned lesson that we have built it into the culture of the organization, wherein we ensure that we give proper training to our franchise partners, because most of them come from different backgrounds, and coming from different backgrounds, they need to have an entrepreneurial mindset. An entrepreneurial mindset has to be a little bit of risky, little bit of, expansion. You have to always look at how do I push my top line, how do I push my bottom line, how do I put my systems. So we build this entrepreneurial mindset into people, training them to become entrepreneurs. How do you look at your cash flow? How do you look at your P&L? And keeping them aligned to the vision of the brand, and also ensuring we're able to give the customer the experience that they deserve when they walk into a store. So realigning the entire business model, our thought process, training, to ensure they're able to build franchise partners who understand this and who become a part of the entire culture is one the major reason why we're able to scale up.
It's what your the term ethical scaling. You've just probably described that term to me right now, if I'm not mistaken, where you're not only you're actually ensuring franchise profitability and some level of sustainable growth, right?
See,
It's not just about chasing the numbers, I believe.
true, right?
Yeah. No, I think
Jatin,
very, very rightly put by Vijay. Yeah. Haji.
so I mean, I think it's definitely a balancing act. But again, as somebody who's entirely new to this concept, how are you? If I were to explain this to somebody who does not have, like a layman who does not have any idea about franchising and probably wants to get into it, how are you benefiting as a company if your franchise, is a profitable venture?
Yeah.
How much? What is the what is the margin of your profitability versus what the franchise owner is making? How is it a win-win situation for both parties? If I
Yeah.
were to understand that.
So Polemy, I mean, that is very much dependent on the whole business model which is being set in place. So, and of course, it depends from businesses to businesses. Like fashion retail would have a different kind of margin versus a education coaching business versus a preschool business versus a salon business or even a nail salon for that matter. Lately, they have been really doing well because of course, their lower cost in terms of investment and higher margins because the product cost is lower. I mean, it will depend on which kind of businesses we are talking about, but then uh, the model which is set in place needs to be more practical. And for a founder, it is very important to kind of because on Excel everything looks very fancy, very easy, very good, and you can just scale it and you can just add 1 point here, 1 point there. Like I can just make 2% more for the partner and 2% less for me, and everything will look balancing and hunky dory. But then the assumptions put in the model is kind of can make or break the model. And I always prefer that all of us, like when we kind of work on an Excel, we should be more than always be conservative than be more bullish, because anything which can, like how Murphy's law goes, like anything which can go wrong will go wrong. So on ground, whenever you are actually onto doing something, things do go wrong. And of course Vijay can kind of second that with his 25 years of like just derby, deep down and dive and all of that. Like every time we as entrepreneurs have gone out and thought that hey, this is going to work, and there have been kind of pushbacks and iterations and kind of 2 3 versions of it to kind of for us to reach where we wanted to reach. And it has never been that in the first time or first attempt everything has worked. So all the assumptions we take in place in the ROI model, which can be what conversions we'll get, what footfall we are going to get, what is the ticket size at which the customer is going to pay, what is the conversion out of the footfall which is going to happen. So all these numbers, all the assumptions we take, ideally has to be conservative and has to be based on some numbers or facts which are actually happening. So as Vijay rightly said, like they were running their own stores, so they had some assumptions from there, and he would have kind of incorporated those numbers in the ROI table and would have actually seen that the same numbers are not true for a partner. And that's where he had to kind of go through that iterative process to understand what is happening wrong with this particular partner. Is it the partner motivation? Is it the location? Is it the conversion? Is it like what exactly is kind of missing from our own store to a partner store? And then he had to kind of retract some of them, start some of them again with the right mindset of partners or right locations or right, like whatever loopholes were identified. And like once these gaps were plugged in, there's of course no looking back to where Derby is today. So things like those kind of matter, and ROI table will vary from industry to industry.
Mm-hmm.
The assumption should 100% be based on something factual, which is actually happening with the brand at this point. It should not be some of these times the assumptions are just from their mind or some from their bullish thoughts or from the team or from some MBA folk who has come in the team and he feels that projection मेरे को अच्छे से आता है, or like a CFO for that matter or a CA for that matter. But then as I said that these Excel, like on Excel everything looks hunky dory and it's always good. आपको सिर्फ you just need to pull the number again and you'll be like 5 years we are going to be the largest company in the world. But then that's not how exactly the world works, and you have to be very conservative in these numbers. You have to be very like it. There need to be a basis to all of this. And yeah, I mean,
Yeah.
I some of these things would kind of help you form a more realistic model, because when the
Mhm.
model is realistic, the execution will be better than the model, and then the partner will love it because the partner will say that hey, you said that conversion itna hoga and conversion is already happening better. You said footfall itna hoga, 300 आएंगे in a month, but then footfall 500 आ रहे हैं, तो partner will be really happy. You said that break even will happen in 14 months. It is break even is happening in 10th month or 8th month. They'll be like,
Right.
they'll be head over their heel and they'll come back and they'll be like, please give me 2 more locations, 5 more locations. So as they rightly say that you need to of course under promise and rather over deliver than going the other way. So yeah, I mean that's the key to some of these ROI model, how one should go about it.
Just adding to what Jatin says, we have a few benchmarks that we like to follow at Dhabi to ensure that we are in the right direction. One is that we want to see a break-even point within the first 3 months of operation, meaning he needs to be profitable within 3 months of him starting the business. This is one milestone that we need to cross. Second is we'll ideally like him to remove his investment whatever is invested into the business between 24 months to 36 months. That is within 2 years to 3 years, he should have got his investment back. So that means his business has already paid back his capital. So after this, whatever he earns is his profit. And generally in a fashion business, we take the business, any premises that we take, in spite of it being a company-owned, company-operated, or franchise-owned, franchise-operated, we always put a tripartite agreement. That means an agreement between the landlord, franchise partner, as well as the company. Because once the franchise partner is successful, he's doing extremely well, you'll have a lot of other brands poaching him and giving them higher profitability, saying that why don't you give this brand away and take our brand? So they get lured away. But when you have something called as a tripartite agreement, where you're having locked in the location belongs to you. That means he cannot change the brand. So you know you have a nine-year runway, wherein the franchise partner has already removed the entire investment between 24 months to 36 months. And for the rest of the 6 years, he's going to be highly profitable, you're going to be profitable, and you've locked in the prime location with you. So these are something that we take as milestones. First to see whether we're going the right direction. Sometimes we achieve it, sometimes it gets delayed, or sometimes it just doesn't happen.
Yeah. This has been incredibly insightful. There are some audience questions that have come up, which we'd like for you guys to answer. So we have Aniket Khandelwal who says, how can founders make sure their franchise partners are financially and operationally capable before scaling to 50 to 100 outlets?
Yeah, I think Vijay, if you would like to. Of course, Vijay has already covered most of
Yeah,
this,
but
but yeah, I would. Yeah, Vijay, if you
you
can.
want to just give me 2 or 3 points briefly to highlight the crux of it.
See, very important is to vet your franchise partners. Please vet them. Understand, we ensure that the franchise partner, whenever he's investing into the first franchisee, it's his own money, so that he doesn't have the stress of bank repayment, or he doesn't have. It can be his own money, it can be friends and family, but it's without any interest bearing. So he has the freedom to operate, wherein he's investing his time and energy in managing the business, operating the business, making it profitable, fine tuning the business, process, so that he's able to scale the business up. So once that happens, the profits from there is where we want him to invest into the second and the third outlet. But from the franchisor perspective, a lot of the brands, franchise owners in the early days are very aggressive, and they want to really expand. Can I open 50 stores in the first year? Can I open 100 stores in the first year? I don't think so. That's the right model, or that's the right way to go. Though few people have done it, but the ideal way will be to actually test the model and see, open it in about 4 to 5 locations, different locations, get your supply chain right, ensure these franchise partners are profitable, your operation is going well, your marketing is going well, you're establishing the thing. So the second year, from 5 outlets, you can add another 15 outlets. That's how the scaling up happens. In fact, if you go through the case of Starbucks, for the first 25 years of their entire existence, they only opened 100 stores. And the 100 stores, they fine-tune the entire business model, the coffee making model, the experience for the customers. They fine-tune. And from the 25th year to the 30th year, they opened 18,000 stores. So that's the way the expansion happens. So it's always, you need to keep a little bit of patience. And financially, when you're doing a franchise operator, franchise operated, you're always getting the franchisee who's investing into the business, because investing into the new location. Your investment goes in ensuring you don't deviate that money. A lot of people also have this problem of putting whatever money you're getting, you're investing into marketing the first year itself, and then you don't have money to scale the business up after that. Because we need to understand that just because you have a good product or service, it's not going to sell. I'm repeating, just because you have a good product or service, it's not going to sell. Everything needs to be sold. Even God needs to be sold. Even God needs, the God that is highest marketed. A Tirupati Balaji will find more amount of visitors going out there just because it's marketed well. So we need to understand, in a world where even God needs to be sold, just because you got a good product or service, you need to be able to market your brand well. You need to be able to set it apart. Your advertising, building the brand is very, very important. So it's very important that you set aside money for that. You're able to do it in a very systematic way. You do not deviate or divert the money that you get immediately, whatever you get, buying into luxury items, upscaling your lifestyle. A lot of these mistakes that typical owners do when they get excited, then they see the money flowing, they use it for other things. So you have to be cautious on that. Jatin?
No, very rightly said, Vijay. I think in a world of full of chaos and noise and everything, like everything needs to be marketed, needs to be present in front of you, for you to kind of have stickiness to a particular brand. And very beautiful story about the Starbucks where they took a lot of time to kind of perfect the model with their initial stores and then kind of expand. And that's what exactly happened with Mixu as well, which the China-based company I was talking to you about. They took a lot of time to kind of perfect the model. Started with ice cream, got into bubble tea, got into coffees, uh, perfected the pricing. Like at what pricing are people buying it in China, are buying it in their own stores and everything. And once they were ready for it, like as I said, after 2019, there was a blitz scale which happened, like 23 store per day is how they expanded. And that was all even after, like, of course, COVID and pandemic and all of that, which was happening. And 2025, they saw their success. They went IPO with all these 46,000 outlets. But yeah, I mean, it is very essential to a founder. I mean, and focus is kind of a very underrated quality which anyone talks about in founders, that you have to kind of focus on your own perfecting your own model, perfecting your own business, making sure that the support system is in place. And like how the question was about kind of providing that support to the partners, like before that there needs to be a lot of things which needs to be perfected. And while they're expanding, then of course things becomes and someone described to me product market fit very rightly, that it feels like you're kind of going with the flow instead of kind of going against the wave. And every time you try to do anything, you feel that you have to put in more effort for the next one. But if you have found a product market fit, the next sale becomes more easier, the next outlet becomes more easier, the next, like anything you do next keeps getting incrementally easier because you've found a product market fit. And if there is no product market fit, like every next customer walking in, you have to spend more. Every next outlet you open, you have to like put in more effort. And if it only keeps getting difficult, that means that you're yet to kind of find the right fit. Pricing may be wrong, the location may be wrong, the product may be wrong, the support system may be wrong for kind of finding these or kind of expanding via franchising. So I mean, yeah, very beautifully put, Vijay. Yeah. Yeah.
So we've sort of come to an end of this discussion.
Yeah.
The big takeaway is this, that there is no one size fits all franchising model. The company owned model gives you control, the franchise owned model gives you speed. The right choice depends on your capital, systems, and long term ambition. And, we would, if you are a founder, again, who is doing a 5 Cr ARR and are serious about scaling into 100x, raising growth capital, and preparing for a strategic exit, you can, take a consultation from Jatin and Vivek. They've built up 300 plus franchise networks and exited ventures to listed entities. And they will be happy to build your 100 partner success story with you. We will be sharing the form link in the webinar for you to register. Thank you, Vijay, for sharing Derby's inspiring journey of creating 1,000 plus entrepreneurs in India. Thank you, Jatin, for decoding the accelerator lens on this scale. And of course, thank you, audience, for tuning in. Our next episode will focus on making your business franchise ready, systemizing the businesses before you scale, because passion starts the journey, but system sustains it. Thank you, everyone, for joining in.
Thanks, Polomi. Thanks, Vijay. Vijay, I think you're on mute, but thanks, Vijay. It was wonderful to have like to be on the session with you. Thanks.
Thanks, everyone.